So I really strongly recommend, I think profit share is the best way to do it, because that means that you have the cash to award to your staff, and it keeps your staff laser focused on the bottom line of how can we deliver performance this year in terms of the profitability of the company. And then that still really, really laser aligns your incentives for the future.
With the changing of the of environments in real estate and in different deals and different markets, like how do you obviously lead with generosity and giving, but how do you come to those numbers? Like these are like a framework that you follow, Nick, that you know, or like how did you figure out it was 5% for profit share and the formula is, laid out for different employees in different years and such?
Great question. So the short answer to that question is iteration. I've had the great privilege to lead multiple very successful startups, first in the technology world and now in the real estate world, kind of taking a lot of models. I mean, when you think of like stock options and stuff like that, you probably think tech. And that was the industry that I was in for a good 15 years. That's not something that's as ubiquitous of a concept in real estate. It's kind of interesting. In fact, I would dare say there's really not a great culture, a standard, kind of environment in the property management world. Sometimes general partners or investors will say that the property managers are just a step above the tenants and they're all liars and thieves and stuff like that. And they'll begrudge how you have to manage your manager and just have a lot of like really negative talk about their residents and their property management staff, which is just always pretty shocking to me to hear. I think that people behave the way they're expected to behave. People tend to rise to your expectations. So what we do is we have I would say a pretty fair compensation package for every member of our team, and we have extraordinarily high standards for those individuals, and they know that if they perform at a high standard, they're going to get the opportunity to participate in the incredible wealth that we're creating here, and that lets us attract really good people and motivate them. You could theoretically award equity, and I do see that sometimes used in the real estate world, but that gets complex, and I would challenge everyone to think really carefully before ever giving away equity, because now this person often has voting rights. Let's say you want to sell an asset or make some significant decision. Does that person now have a say? Even a minority say. It's another signature that you need to collect. An alternative to that is to have an entity that contains within it the equity shares for people that are in that equity share program, and then you have control of that equity. But even me saying that out loud gives you some indication that can get really complicated, right? Very quickly. Revenue share, I would say, can be an inherently unsustainable type of share to offer, because you have up years and down years in terms of profitability that may or may not be directly correlated to revenue. I hang my license at Keller Williams, and once upon a time they had a revenue share program in this organization, and they had to switch to profit share because they figured out, well, shoot, some years we do have really strong revenue but really poor profits, and then we're paying out this revenue share payment that frankly we're ill equipped to afford. So I really strongly recommend I think profit share is the best way to do it, because that means that you have the cash to award to your staff, and it keeps your staff laser focused on the bottom line of how can we deliver performance this year in terms of the profitability of the company. And then that still really, really laser aligns your incentives for the future. So we'll tell our staff, we have a number. If we were to sell the company today, there would be a huge profit event that would occur in the company, right? So there'd be, let's say $10 million of profit realized. So there'd be, $500,000 of profit share paid out to the staff at that time of sale. And here's, the amount that you would get based on the formula today. That's something that we can know with scientific accuracy. And I think that gives us the best of both worlds, that we can tell someone, hey, you don't have equity in the company because there's a whole bunch of complexity and strings attached that go along with awarding equity. But you have something that's very close. You have, essentially a profits only interest in the company. And if the whole company were to sell, here's what your payout would be today. And here's the profitability of the company this year. And here's your portion of that profitability for this year. So it's an incredible, it's like 0.01% of the complexity and overhead of an equity sharing program, and it still gets you the majority of the rewards. Something else to think about is if you ever do sell your business, it's very likely that you're going to have an earn-out provision. and it's very likely that you would want to, pay stay bonuses to your staff, right? So we already have the entire exit for our whole company built right into our profit share program that we're able to be really, transparent about with our staff along the way. So let's say that there was, a 1 year or 2 year or 3 year earnout or something like that. We'll make sure that those final profit share payments are in lockstep with that. So again, everyone's incentives are laser aligned from company inception to the full exit of that company.